We're looking at the new standard ACCA 315 revised 2019. Now, the previous standard that we had was called Identifying and Assessing the Risk of Material Misstatement through Understanding the Entity and its Environment. So this part here has been removed, and the title just includes that top part here. All right. It's important for you to know that the standard has been revised and there are some changes from the previous one. So let's have a look at these two words here, identifying and assessing. So the objective of the auditor here is to identify first and then to assess. I'll explain what the difference is in a minute. So let's have a look at the requirements of the standard. Remember, the requirements of the standard speaks about the mandatory requirements. Therefore, you've got the word shall. Shall means must. So the auditor shall design and perform risk assessment procedures. So that's the first part. Risk assessment procedures. Why do we need to carry out risk assessment procedures? The reason is because we want to make an assessment of risk. So the first part here, it says carry out these procedures. What do these procedures include? Risk assessment procedures will include these four procedures. I've got an acronym here called AEIO. So that stands for Analytical Procedures, Inquiry, Inspection, and Observation. We'll deal with them in a bit. Okay, we just want to run through the mandatory requirements of the standard. So what is the first part? Carry out risk assessment procedures to identify and assess these risks. Okay, the second part here about this risk assessment procedures here is we need to have an engagement team discussion. So again, we've got that triangle here. The top part of the triangle, the pink part, would represent the engagement partner and the key engagement team members. So what would they be discussing? It says here the engagement partner and the key engagement team members shall discuss the application of the applicable financial reporting framework and the susceptibility of the entity's financial statements to misstatement, material misstatement. So here, the discussion is more to finding out which parts of the financial statement, which transactions, which account balances, and which disclosures would be misstated. So that would be that discussion. So in the standards, there's a lot of that discussion because different members of the team would be able to provide different aspects of insight. Everyone has got different experience. So when they come in and discuss that together, someone else's experience and insight might just make the team that much stronger. So that's good. Then let's talk about the green bits here. The green bits are more of the juniors, aren't they? So it says here when the engagement team members are not involved in the engagement team discussion. So this engagement team discussion is talking about that discussion, because the discussion would normally be just the pink people, right? Then the engagement partner will determine which matters are communicated to them. And this is normally communicated to them during the audit planning meeting that we just saw in ACCA 300. So that's the first part. What's the first part? We need to carry out risk assessment procedures, and there has to be that engagement team discussion to discuss which financial statement items might be materially misstated. Let's go to the second part of the standard, the second requirement, obtaining an understanding. So even though the title does not have the word understanding anymore, we still need to obtain understanding. But this one, slightly different from what you may have done in your earlier audit paper, because this one is a revised standard. So it says here that the auditor shall perform the risk assessment procedures that we talked about just now. But to obtain an understanding of what? There are three major areas. All the yellow areas are the three areas. First of all, the entity and its environment, the applicable financial reporting framework, and as far as our exams are concerned, the applicable financial reporting framework would be the IFRS. Then the last yellow bit is the entity system of internal control. All right, and there are 5 internal controls here. I've just arranged them into an acronym that I use for my AA students. All right, I'm sure you're familiar with them. So this one is still from the COSA framework. That hasn't changed. Now let's go back here to the second yellow line, the applicable financial reporting framework. So included inside here is this thing called the inherent risk factors. So they are sort of linked inside there. So this inherent risk factors is a new term that is found in this revised standard. We'll deal with that later. Okay, I don't want to confuse you at this stage. So just need to know that the understanding of the entity and the environment, here, let's just color this yellow, involves three areas: the entity and its environment, the applicable financial reporting framework, and the internal controls. Moving on. So here the standard uses two words, identify. Identify is just to identify. The word just says identify, to find something. Then you've got this word assess. Then the word assess here. So assess here is going one step further to look at the likelihood of this risk materializing and the magnitude of the misstatement, the dollar value, the size of the misstatement. All right, so there are two things, identify and assess. You have to identify first before you assess. Okay, identify is the first one. Now let's have a look at the second one. The second one, they include these words, significant classes of TAD, and that's a new phrase brought in by the revised standard. So what can be significant classes of these transactions? Now, significant classes of transactions simply means that one or more assertions in that financial statement item could be misstated. Let me explain. So let's go down here, supposing that you've got these financial statements here, and I provide you this information. The revenue has gone down. Then PPE would be considered to be a significant class of account balance. Account balance because it's in the SOFP. Why are we worried? Because we're worried about the assertion of valuation, accuracy, valuation, and allocation. Because if revenue has gone down, that means PPE would have to be tested for impairment, wouldn't it? All right. So impairment means you're going to bring the value down. So the assertion that is at risk here would be valuation. Accuracy, valuation, and allocation. Now let's have a look at this next one, intangible assets. Do you think this would be a significant class? Why? So here, if you look at last year's figure, is 0, right? That means this one is totally new. Everything has been incurred this year. So this one would be considered to be a significant class. Why? Because we're very worried that research expenditure has been capitalized. So again, this is a financial statement item, an account balance, where we're worried that the asset may be overvalued. The assertion here would be on the area of valuation again. Let's go down to current assets. And here we've got a little bit of information from the analytical procedures that you've done. Remember, the risk assessment procedures just now was what? A, E, I, O. Is that right? So this AEIO, the first A there, is talking about analytical procedures. So assuming you've done some analytical procedures, you find out the inventory age. You can see here that the inventory age has deteriorated. This year is 60 days. Last year is 30 days. So find inventory would be another significant class of account balance, because it could be overvalued. The assertion here is on the area of accuracy, valuation, and allocation. Same thing with trade receivable. The age has deteriorated, therefore the recoverability of the receivables is kind of worrying. So very worried that the trade receivables will be overvalued. Again, the assertion is what? Accuracy, valuation, and allocation. But how about the cash transaction? Cash transaction, normally it would not fall under the category of significant class of account balance. Why? Because cash balance or bank balance can be reconciled to the bank statement. So that's not a problem. But when could it be a problem? Well, it could be a problem if, let's say, some of this money is stuck in a country where there is political instability, and therefore it might be difficult for you to take out that money. Then yes, it would be considered to be a significant class of account balance, because the valuation of that bank account balance would be in dispute. Why? Because if it's in that foreign country and they are experiencing political instability, then there might be difficulty in you taking out the money. And if you can't take out the money, then what's use of it to you? So the value would go down, wouldn't it? All right? Or another reason why this item might be a risky item, it might be considered to be a significant class of account balance if that cash was held overseas and let's say there has been a significant fluctuation in the foreign currency rate. And therefore, there's a possibility that that figure could be materially misstated. So let's go back up here. So significant classes of transaction, account balance, and disclosures simply means the financial statement items that might be misstated. Okay, nothing mysterious about it. The only thing is that in the revised ACCA 315, they've introduced a new term. That's all. No big deal. All right, let's move on. So here you've got these purple words here called significant risk. So the auditor shall determine whether any of the assessed risks of material misstatement, this what we've assessed here. So whether any of those assessed are considered to be significant risks. What does that mean? So if you look at this diagram here, significant risks would be those financial statement item which has got a very high potential of misstatement, a high magnitude of misstatement. That means if it's misstated, the misstatement is going to be very big and also very high likelihood of occurrence. So the impact on the financial statements would actually be quite great. So out of the ones that you have assessed, to find out which ones are the most risky, the highest magnitude and the highest likelihood as well. So this one, under the revised standard, the definition of it slight different from the old one, so you got to be very careful. All right, so we'll deal with it in a bit. Okay, so moving down here, this diagram here is actually taken from the revised standard. It's a very nice diagram. So it says here right on top that the risk assessment procedures, you have got to obtain an understanding of the entity's internal control, the entity and its environment, and the applicable financial reporting framework. We've got the discussion here that we talked about just now. So you can have a look at that yourself. It's a very interesting diagram, very good. Just now when we started off, we talked about the two words, identify and assess. So the auditor shall identify and assess the risk of material misstatement. Identify whether there is risk at the financial statement level and at the assertion level, and then assess how serious it is. So now what I want to do is I want to have a look at the meaning of the word risk at the financial statement level. So when you say risk at the financial statement level, we're saying it is a risk of material misstatement which relate pervasively to the financial statements as a whole. Now, when can this happen? The risk of the financial statements as a whole. This one. So let me explain. So this one is usually to do with manipulation, where management is involved and they're trying to manipulate different aspects of the P&L, the SOFP, and maybe even the notes to the accounts to try and give a different picture to the shareholders. So when do you think that will happen? Let's have a look. So one incident is where management bonus is based on revenue. In that particular case, you're going to find that revenue is going to be overstated and there might even be some bogus sales transactions. So they would have credited the sales bogus credit. And when you credit sales, you have to debit something. So you're going to debit receivables. So that's why the receivables here is overstated. So you find that revenue will be affected. It could be misstated. And there are three assertions here: occurrence, cutoff, accuracy. Management could be playing with that revenue figure. And there are three assertions here. Therefore, revenue would be considered to be a significant class of transactions. And because when they credit sales, it is a bogus credit, then the debit will be bogus as well. So then receivables will also be considered to be a significant class of account balance because there's some assertions there that might be misstated. When else can this manipulation take place? Well, management bonus could be based on the profit before tax, or the entity could be listed and the earnings per share is going down, or the entity is desperate for financing, desperate for a loan, so that their overdraft will get renewed, something like that. So in this particular case, many financial statement items are going to be affected. So if we look at it on the right hand side, these are financial statement items that would be considered to be a significant class of account balance. Because this expenses here would be a significant class of transaction, because a lot of assertions here are affected as a result of this. So when do you have risk at the financial statement level? When there is manipulation. And who will manipulate it? Not the juniors in the company. It would definitely be management. So let's have a look at this. This diagram here, this box down here, is actually taken from your ACCA 240 notes on fraud. So here we're talking about fraudulent financial reporting. Okay, and with fraudulent financial reporting, there is this continuum here. Continuum simply means that there is, at a lower level, it is not so serious, and then it just goes up to super serious. So that's a continuum here. So when management try and manipulate the financial statements, they could do it very, very subtly, not so obvious, or they can just outright just create bogus revenue transactions. Or maybe not even do that. If they want to increase the sales, they just put through one journal entry, debit something and credit revenue, and that's it. Straight away, your revenue goes up and your profit goes up. So again, what is risk at the financial statement level? Where the whole financial statements is affected. When will the whole financial statements be affected? Usually when there's manipulation. Risk assessment procedure. So this is one we're revising a little bit of our earlier audit paper. The risk assessment procedures, AEIO, has not changed from the old standard. However, in the revised standard, they have included data analytics inside as being one of the procedures that we can use to identify and assess risk of material misstatement. So we've got AEIO. Please read that by yourself because you've already done that in your earlier audit paper. Okay, so I'm not going to go through that again with you. Very easy to read. Analytical procedures here. You've already done this before. What are the techniques that you use? You can have comparisons. Comparison is just comparing with something. You can compare with a budget, but of course, in your exam, budgeted information will not be given. You might be given financial information with related financial information. So this one is one of the popular ones that we use in our AAA paper in question 1 to calculate tax with the profit before tax, and that will give you the effective tax rate. That's very common. We can also compare financial information with non-financial information. So sometimes in the exam, you're given the number of employees, and you're also given the monthly wages or the annual wages. So if the number of people go down, then you expect the monthly wages to also go down. But if the number of people go down because let's say there's been a layoff, some redundancies, and then the monthly wages goes up, something funny is happening. It could be fraud. Trends is always comparing the results with the previous year's results. So it could be that you're saying that some of the figures have gone down, or it could be that some of the figures have gone up in relation to the previous year. Increase, decrease. Then we've got ratios. So many ratios that you can calculate. Now, I will talk about ratios and analytical procedures more when we start doing question 1. So this one is a theory part of it, but when we start doing question 1, I will show you how you can use analytical procedures inside your answers to gain marks and what not to do. But that one we will do when we start doing question 1. Okay? Areas to obtain understanding. Earlier we talked about these 3 areas. The entity and its environment, the financial reporting framework, and the entity system of internal control. So under the entity and its environment, you can read this, okay? It's exactly the same as what we had before. Just want to point out to you, here we've got this thing called business risk. Okay, so we're also looking at the business risk. Now, please read this, okay? I'm not going to take time in the video to go through it with you. You can very easily read that. Now, the financial reporting framework, we're looking at what standards that they're using. So this one will usually be IFRS by the parent company. So we need to see what kind of accounting standards they're using. So if you have got a subsidiary that is in a foreign country, you need to be a little careful in the exam. The examiner will tell you whether they're using IFRS or some other financial reporting framework. So you need to be careful with the accounting policies, see whether they're appropriate. If they're changed, see whether the change is reasonable and that the client is not changing the accounting policy just to increase the profit figure. Like, for example, to increase the age of an asset just so that your annual depreciation could go down. Now, let's come to this inherent risk factors here. Now, this one is new in the revised standard. So these are the factors that give rise to material misstatement in the financial statement items. There are 5 items. I just arranged it in the form of an acronym SUCKS. So this really sucks because it makes the financial statement items misstated. I'll explain what they are in a bit. Just hang on. All right. So the entity system of internal control, you need to also understand it, but I'll deal with that in a minute. Now, you know from your earlier audit paper that if you have poor internal controls, it can also give rise to misstatement. Please read this by yourself. Now, let's come back here. Now, dealing with the revised standard. We still have the 5 components of internal control. What are the 5 components of internal control? The acronym that I use for my AA students is CRIME. And I've already explained to you what they are just now. So this CRIME here will now be divided into 2 categories, into indirect control components. And this one would be the control environment. So all the blue bits come under indirect control components. Indirect means that they do not directly affect the financial statement items. So the revised standard makes a distinction between those internal controls that have got a direct effect on the financial statements and those that do not have a direct effect. Not to say that they don't have an effect at all, that they do not have a direct effect. The internal controls that have the direct effects is control activities. This one, control activities, and information and communication. This is to do with the accounting system. Now, what's the difference here? The revised standard says that for this category of internal controls, the direct control components, we're supposed to ascertain the internal controls, find out about the internal controls, document them in the permanent audit file, carry out a walkthrough. That means we're going to confirm it, make a preliminary assessment of control risk, and carry out the test of control. On the other side, we are only going to do the first 2. We're not going to do the last 3 steps. Why? Because for control environment risk assessment processes, which is the internal controls that they have to identify business risks, we are not going to test them. We're not going to carry out tests of control. Whereas the direct control components, we're actually going to test them. So if you're going to test them, then you have to make an assessment of control risk. Are we good there? So this standard makes a distinction between the 2 kinds of internal control, which is really brilliant because it tells the auditor which you have to test and which you have to just ascertain to obtain the understanding, because we still have to understand the internal control. Same thing on the other side. We still have to understand. There's no 2 ways about it. But now the question is, which ones are you going to test? We only test the ones relating to direct controls. Now, let's have a look at this. So you're already familiar with the 2 words identify and assess. So identify is just identify, okay? So identify risk at the financial statement level, identify risk at the assertion level. Financial statement level means manipulation, yeah? And to identify the significant classes of TAD, those that might be misstated. Just identify them. Then you need to see how serious they are. That's how you assess them, to look at the likelihood and the magnitude. Okay? Now, the reason why we have to do this is because of this. If we can assess the risk at the financial statement level, then we can design something called the overall response. If we can assess something at the assertion level, we are going to design something called the specific response. So we'll look at these responses again when we're dealing with ACCA 330. Now, in this particular paper, you don't have to memorize the standard numbers. There's no extra marks given there for you. I'm just telling you so that you can watch out for it in another lesson. Okay, then to assess which are significant risks. So we explained that before. Significant risk will be at this level. the highest level, highest magnitude, and highest likelihood of occurrence. These are very, very serious. So the inherent risk factors here, sucks here just now. I'll explain what they are in a minute, but let me just go through this first. Sucks would be at this stage. Any financial statement item which has got sucks, that means they are subject to subjectivity, uncertainty, complexity, change, susceptibility to management bias, the magnitude for potential misstatement would be very high. So any financial statement item which has got more of one of sucks is likely to be a significant risk. So here we've got sucks here, so if I can just copy that. So those areas that are considered, those financial statement items that are considered to be of significant risk would have a higher amount of sucks inside there. This is important for you, important for your question 1 in September. But I'll explain that further when we start doing question 1. Now, in this standard, they talk about the spectrum of inherent risk. Let me explain. So what is the spectrum? A spectrum speaks about sort of like a continuum, it's like a long line, and some risks could be here, and some risks could be here, and some risks could be here. So this diagram here actually shows you the spectrum, that there are some risks where you got high magnitude but low likelihood of occurrence. And this one has got a high likelihood of occurrence, but it's got a lower magnitude. So this is the spectrum. So the ones that are on the higher spectrum, like here, would be considered to be a significant risk. But items that have got more of sucks, because sucks is in the area of high magnitude, isn't it? Then it would be more likely that it would be a significant risk. So here's some explanation on sucks. On the area of high subjectivity, example, transactions where there are multiple acceptable accounting treatments. Like in the area of depreciation, you can calculate depreciation on a straight line basis, on a reducing balance basis. You can have a life of 10 years, a life of 9 years. So there's some subjectivity involved inside there. Included inside here is another example is construction expenses. In your construction contract, so trying to make an assessment of the recognition of the income and the expenses, there's some subjectivity involved in here. It's not so easy when you're thinking about IFRS 15. No doubt we're talking about performance obligations that have been completed, but still there's some subjectivity involved inside there. Another example here is investment property, and I've given you this excerpt here from IS 40, and it says here that for an investment property, you can choose whether you want a fair value model or whether you want a cost model. So there's some subjectivity involved inside there. So investment property would be considered to be an area that has got high level of misstatement. Anything with a high level of misstatement would be considered to be a significant class of transaction, account balance, or disclosure. Uncertainty. So here you've got accounting estimates. Now, not all accounting estimates come under this category. Here, what are we talking about? We're talking about high estimation uncertainty, like provision for decommissioning in 100 years. Oh my goodness, how am I supposed to know what the cost is going to be in 100 years? Not only that, but how will I know what is the environmental legislation going to be like in 100 years? It's probably going to be very, very tight. And so the cost of decommissioning is probably going to be super high in 100 years' time. But you'll have to make an estimate of what kind of environment legislation there's going to be, isn't it? So high level of uncertainty. Court case finalized in 2 years' time. So you won't be able to know how much the provision for the legal claim would be. But at least that is 2 years and not 100 years. High complexity, where you've got accounting estimate that makes use of models. Like, for example, in the case of the fair value of the share options at the grant date. So there you'd be making use of a options pricing model. Whenever you use these complex models, there is complexity that is involved. Another example is the area of supplier rebate provisions. A very good example here would be the case of Tesco. And Tesco had a scandal a few years ago. The auditors were Pricewaterhouse and they did not manage to pick it up. One of the reasons why they did not pick it up was because the materiality level was very high. You can go on the internet and check out that scandal. But the area of misstatement was the area of the supplier rebate. Because when you're dealing with supplier rebates, it's really funny, where the supplier will tell you, if you buy 10 items in 1 month, we will give you so much discount. But if you buy 40 items in 3 months, you will have a different discount. And if you buy 90 items within 6 months, you have got a different discount. So the discount model is going to be very complex. Discount is the same as rebate. Complexity, anything with a complex calculation, or here we're talking about complex calculation. Here we're talking about complex regulation. Like, for example, your client could be listed on several stock exchanges. So that becomes very complex. Different stock exchanges have got different rules and regulations. Existence of complex alliances and joint ventures. You've got special purpose entities. It becomes very, very complex then. Change. Any kind of change. Like one very simple change is you're a single company and suddenly there's an acquisition, then you become a group all of a sudden. Or changes in the accounting standards. Changes in the entity's business model. Like very common nowadays as a result of COVID, a lot of shops are closing down because everybody is buying online. So whenever you've got changes like that, then there would be problems on the area of revenue recognition. It's so much more easier to calculate revenue when you have got a shop because of the cash collected. And of course, online revenue, it would also be cash collected. But the point down here is that revenue can only be recognized when the goods have been delivered, when the performance obligation has been completed. In a shop, it's so easy to see the completion of the performance obligation because a customer will take the things in a bag and go off. Susceptibility here, we're talking about manipulation of financial statements. And then we've got one more item here. Now, this is important. So this one doesn't come under SACS. It comes under a different category here. Financial statements which are treated as significant risk in accordance with the requirements of other ICAs, like, for example, related party transactions. So how does the significant risk come here? Anything which has got lots of SACS or high level of SACS is going to be an area of significant risk. Okay, so don't forget the part about the related party transaction. So let's have a look at the definition of significant risk. Slight change from what we had before. It says here, determination of significant risk allows for the auditor to focus more attention on the risks. So these are items that require more attention. Now the question is, what kind of attention? And you need to make sure that you're familiar with this. Under the previous standard, it was not defined. So now it has been defined. What is the meaning of more attention? Please read that by yourself. What this attention is. Are we okay? So we're done with ISA 315 revised 2019.